a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Looks like gold mining ETFs have been falling right along with the price of the metal. Eric Dutram, our ETF strategist here at Zacks, is going to tell us why. So what is this recent trend in trading these ETFs?
Well, a lot of the gold ETFs, they started off the year on a pretty good note. But around January 22nd, they sort of topped out. And since then, GLD and IAU, which are the two main gold ETFs that investors can buy in the market,
Okay.
these have actually been severe underperformers, and they've actually lost about 11% since this time frame. So it's been a very weak spot for gold here, and that's due to a strong dollar. There's concerns over a Fed rate hike, and inflation worries are pretty much non-existent right now. So all these factors are sort of combining to push the price of gold lower, and it's really been a horrendous month over the last couple weeks here for both these popular ETFs. And if this trend continues, we could be looking at 15–20% losses for both these funds.
So the gold miners have really been getting slammed here.
That's right. Gold miners, actually, they often trade as a leveraged play on the underlying metal. And what that means is a lot of times gold miners, they'll actually go down more when prices are falling, and then they'll sort of beat the underlying gold bullion when prices are rising. So you're going to get a lot more leverage, if you will, and a lot more volatility in this space than in the actual underlying metal. So that's definitely something to consider, and it also doesn't help that a lot of these securities in gold mining ETFs, they're foreign holdings, so you're going to get a lot of currency risk. And as we saw, in the previous slide, the U.S. dollar has been very strong, so you're going to get hit on the gold price and in the actual international trading as well. So it's kind of a double whammy, if you will, for gold mining ETFs.
So you have a couple of names for us.
That's right. A lot of times investors focus in on the two most popular funds in the space. We got GDX and GDXJ. The main difference here is GDX is it holds all the large cap ones, and GDXJ is the junior gold miners. So you're going to get a lot more small, mid-cap type firms. So that's going to be a lot more volatile. And actually, since that high water mark around January 21st, 22nd, GDX is down over 21%, and GDXJ is down almost 28%. So pretty horrendous trading here over basically a little over a month. And we might see these trends continue, and obviously these are much worse performances than what we saw in the underlying gold, which was just as reference down about 11% in the same time frame. And once again, the U.S. exposure for both these is pretty low, so you're getting that double whammy I was talking about earlier. GDX, it's only about 10% in U.S. holdings, and just a slightly higher level in GDXJ. So these get really hurt when you sort of repatriate the currencies back to U.S. dollars. So that's definitely something to consider. And if this strong dollar trend continues, and very well might, given a lot of the pressures on other foreign currencies, it's definitely something to consider for investors out there.
But there is more, you say.
That's right.
There is, in fact, a way to play this with inverse gold mining ETFs.
That's right. There's a couple inverse leverage funds out there. And granted, these are going to be very volatile, and they're going to be very high-risk products. But I just want to briefly highlight how well these have been doing under these very bearish conditions. So these products, they actually go up when gold mining funds go down. So as you might be able to guess, they've been doing pretty well here over the last month or so. And we've got two funds we want to talk about briefly right here. DUST is the first symbol, and then JDST for the junior gold miner inverse product. Right. Both of these are 3x products, which means they track triple the inverse of the underlying index. So if GDX goes goes up 1%, this should go down about 3%. So you're definitely going to get some big moves here, and we've seen that recently. And if you actually look at the performance since that January 21st, 22nd point, DUST is actually up 81% just since January 22nd, and JDST is up nearly 120%. So pretty massive returns for both these, but it really speaks to the leverage that you see in this leveraged inverse market. And so definitely high risk, high reward here, but something to consider if you think the gold mining trends might continue.
They call it dust because that's what the price of the metal's turning to?
I think so, yeah.
Do you own either of these?
I do not.
Okay, check out other information regarding ETFs, commentary, and commentary on specific ETFs, more specifically for your consideration, at Zacks.com. You can link to it right off the homepage using the Funds tab at the top, in the top toolbar. With Eric, I'm Terry Ruffalo.